Hey folks, welcome to yet another episode of Business Redefined, your weekly, most comprehensive look at the world of business, finance, and economics. Now, the global funding landscape has evolved significantly. We are seeing funding cuts left, right, and center. ODA has declined. And in that context, DFI or development finance institution financing is gaining traction and becoming increasingly important. I want to talk to Norfund, which is, of course, the Norwegian DFI, and get a sense of the interest in this market and what is being done. And you're privileged to have the outgoing CEO, I should say, that is Mr. Telef. Welcome on set.
Thank you, Julian. It's great to be here.
Wonderful. It's not very common, in my experience, that you find a DFI that is largely equity-based financing. So maybe start by telling us about Norfund and then telling us why the skew towards equity financing.
Well, I mean, Norfund was set up a little later than most of the DFIs in 1997, but we've been growing steadily. We receive new funding every year, so we've become sizable, one of the largest in Europe. Our structure is such that we are not leveraged on the balance sheet. We don't take up debt in a holding company like most other DFIs. Thereby, we're more like an evergreen investment fund, and as such, we don't have to produce stable returns. We can take a higher risk, and as such, do more equity. And also personally, and my board feels that by taking on equity positions, we are more additional, we are more sought after than if we just provide loans. And not saying that loans are not important too, but equity is even more needed.
So what is the typical structure of your funding? Is it a mix of equity and debt? Is it a bit of mezz, or how does it look like?
Depends on the deal and the needs. So we do about 30% of what we do in debt, 70% in equity in the total balance sheet. But if when we engage with a company, sometimes they need pure equity as we join them as owners on a pari passu basis with ordinary stocks. It could be sometimes hybrid funding if that's needed, particularly if it's a family company and they don't necessarily want to ever exit. It's kind of hard to sit there and be a minority shareholder. We're always a minority, we never take a majority. Then there has to be some kind of a hybrid, so we also get out at some point in time. Because ideally, we like to use our funding to make things happen, i.e. to get new ventures off the ground or to support the growth. But when we're no longer needed, we don't mind selling out or being replaced by others. And that's particularly the case on the energy side, where when we built a solar park or a hydro project, and if that's up and running, as owners, we're no longer active. And if we then a pension fund can take our shares and we can reuse the funds and deploy them again, we make a bigger difference.
Okay. And given your skew towards equity financing, one of the headaches then players like you would have is on the exit routes, especially when you're looking at the frontier markets. I'm very curious as to your experience. I'd imagine the energy sector would not be too much of a headache, but what about the rest of the sectors?
You're right. I mean, obviously, exit is a big headache for everyone in Africa. I mean, in Europe and the US, the equity markets are more mature. The stock markets are much larger. The total market cap of most stock markets in African countries are minuscule compared to the total size of the economy. And also, you don't have as many specialized players in the value chain that could, for instance, later stage venture funds or later stage private equity players or secondary players, so that there are fewer takers. And there's less liquidity in terms of buying and selling of companies. But that's also, bear in mind, that's also a relatively new phenomenon in Europe and the US. It's not that that's always been the case. That's also come with the emergence of the private equity industry. But that's a headache, and particularly for the private equity funds and the venture funds, because if you raise funds for like a 10-year period from pension funds, it doesn't help sitting with good stakes in very interesting companies. At the end of the day, those that have entrusted you funds, that being pension funds, the pensioners would like to get their pension, not necessarily just owning stocks in promising companies. So that's a structural problem. And something we've been pondering: how could we help? How could we help get things moving? But I wouldn't say that we have the solution. It's a bigger capital issue for the market issue.
Interesting. How large is your Africa portfolio, and what does the Kenya portfolio look like within that context as well?
I mean, in total, we have about a total portfolio, as we speak, about $4.5 billion. Of that, last year, about 70% of what we invested was in Africa, but in cumulated terms, I think it's 63, 64% Africa. And Kenya was the first country where we set up a separate office. Kenya has always been important to Norfund as a hub, not just for East Africa, but also for in a wider context in Africa. It's been the largest country for us in terms of where we've been most active. And I'd say that, East Africa, I think we have about 1.3 billion, and Kenya is the largest country in that setting. As such, Kenya is very important to us. And also, it's also a hub in terms of attracting expertise, in terms of attracting strong management teams, international players. Yes, Kenya is indeed core to what we do.
I know in the interim remarks you did mention that because of the nature of your design, then you have a lot more risk appetite and you can take on more than your peers would. I'm very curious, from a sectoral focus perspective, is it that you don't segregate across sectors and you basically gobble up what is compelling by way of return?
Well, parts of what we do through funds. We have about 20% of what we do through funds, and there we invest in whatever those funds want to do, and typically many private equity funds have a wide sector coverage. But when we make direct investments, which we do most of, we cannot be all over the place. We need to be specialized. We need to understand the drivers in certain verticals. We need to know who the good players are. So there we do financial institutions. We do, for instance, here in Kenya, we own a large shareholder in Equity Bank, as an example. We do renewables, and we do what we call scalable enterprises, which are traditional, have been agri-processing, but we also do manufacturing, a range of different manufacturing plants, everything from textiles to paper production to the likes. And we also do what we call green infrastructure, where we, for instance, do recycling or waste recycling or paper recycling or plastics, as examples of niches and sectors that we focus on.
Okay. This market, whenever we talk about the sort of financing that comes from players like Norfund, then the question of the ticket size looms large. And there is a sense in which the market needs a lot more smaller ticket sizes than players like yourselves would be willing to extend. How has your experience been, and what do you see as the way forward in this?
It's a good question, and it's also a conundrum in the sense that, when we invest close to $1 billion every year, it's kind of hard to do that if you do in ticket sizes of $1 to $3 million, right? Because we'll end up having far too many companies to follow up. And also we do have, being a DFI, representing taxpayers' money from Norway, we also have stricter E&S requirements and like health and safety requirements and so on. So there needs to be a certain quality of the companies you invest in. My team here is pushing me that we should be making smaller tickets. So we try to do that at times.
How small is small, by the way?
Typically, we normally invest no less than $5 million, but typically more like 10 to 20. But it's particularly an issue with companies, started by indigenous Africans. They're not that many companies that are able to take on such large funding, and particularly because also we have to be a minority investor. So that's an issue. So we partly do by also investing through funds that specialize in smaller companies. And we also look into various ways of how can we do that in a better way.
And in terms of the road ahead, and I know you're on your way out, but how does the pipeline look like? What sort of areas are pricking your interest by way of focus in future investments in the near term?
As you mentioned in your introduction, given the world economy and how things are moving, there unfortunately also a number of private investors from US in Europe, they're pulling out. There's less aid money, as you know. And there's more south-south, both investment flows and trade. That's a good thing, by the way, because Africa and Kenya and this part of the world used to be too dependent on Europe and the US. It's good that there are several players that you can play up against each other and that can be competing for investment opportunities in Africa. So that's a positive. But for us, it's also not necessarily so that we can team up with all those partners. But we are optimistic in the sense that we have a strong deal flow as we speak. And optimistic meaning that we, as a DFI, are needed. We see a decent pipeline. that being here in Kenya and also in other parts of the region. But clearly, I mean, the political situation, I just came from Ethiopia, where it's been, quite challenging lately. Uganda has its issues. It's a region where there's never a dull moment, and there's always something happening. But we set up to take risk, and I think many Europeans and European investors and American investors, they focus too much on the risk factors. What has impressed me a lot, having been working on this now for some 8 years, is the ability of African entrepreneurs to sustain and to drive the companies through big changes. In Europe, when there's a big change like COVID, European entrepreneurs and business leaders were petrified. But in Africa, that was just, COVID, I mean, we're used to this shit. We used to handle difficult stuff. Let's just move on. And that has also energized me, meeting that ability to maneuver through big changes, challenges, keep on growing, and be focused on future growth.
Okay. To what extent is the growing conversation around sustainability impacting your investments? And I know a couple of your investee companies are basically dealing in renewables energy. Yeah.
No, I mean, clearly, we on the energy side, for instance, we only invest in renewables. We have some gas-fired power plants in the portfolio, but these days we focus on the renewable side for two reasons. One is that that's what we set up to do through our mandate, but also because we're seeing that that's where the most opportunities. That's the cheapest way of delivering energy these days, and particularly solar and wind. So as such, it's a win-win in the sense that that's nowadays the most affordable, the best way of producing energy, but it's also good for the environment. But it is a challenge that we're seeing some larger companies now being less willing to invest in green solutions. There's been a change of not just in terms of the way investments are being presented, in terms of the way you describe what you're doing. If you look at annual reports in the US and so on, I mean, you're supposed to speak about neutral energy source provisioning and that kind of language. But we're also seeing some investors stepping back, right, and now more focused on oil and gas, as an example. I think that's a pity, obviously, and as such, we as a DFI need to do more. But it helps me and it makes me optimistic that the economics is such that renewables is the answer.
Okay. Looking back at 8 years, would you say that, because oftentimes the argument that is leveled is that players, when DFIs come into the space and help provide capital, then it de-risks and crowds in more alternative financing for enterprises, whether it is through commercial banks, whether it is through microfinance institutions. Would you say that when you look back, you can actually feel that, yes, that impact is being felt?
Yeah, what we've been told is that when Norfund has invested in a company, that's a stamp of approval, a stamp of quality, and also people know that there is a large shareholder with deep pockets that can be there to support the company going forward. So we've been seeing again and again that the importance of our investment has been bigger than the actual investment as such. And also we tend to also bring in external board members with relevant competence. We try to add value also on the ENS side in various ways. So it's being seen as important for most companies that they can show for Norfund or a larger DFI is part of the ownership.
Okay. I'll just close by focusing on the impact conversation, because one of the big headaches we have in Kenya, in the larger African region, is the question of jobs. How do you quantify that impact in Norfund investments?
No, job creation is essential, and it's essential for Africa. And I'm also trying to tell my politicians that's also actually in the self-interest of Europe, as they want to limit immigration, that we actually invest in job creation in Africa rather than just building fences. That being said, I mean, first we measure job creation. We measure how many people are working in our companies every year. It's a key milestone that we are tracking. So like in 2024, there were some 740,000 employees in the companies they were invested into. We don't have the exact number for 25 yet, but typically it's been growing along the lines of 40 to 50,000 employees every year in the companies we invested into. We also measure, and another important measurement is taxation, how much tax those companies pay. Obviously that too being important for sustaining and building a public sector that in turn can provide health and education and the likes.
Okay. As you look back 8 years, what would you say has been your highlight, especially if you're looking at the Africa-focused investments?
It's kind of hard to pick single companies because it's a bit like asking who's your favorite child. But what really makes me tick and what gets me up early in the morning is meeting entrepreneurs and meeting other people that have gotten a decent job, seeing the pride when people have a decent job, and also seeing the pride in entrepreneurs are able to build those jobs. That I find so incredibly meaningful in terms of what I'm doing. So that's what makes me tick. But on the fund level, one highlight for me has been partly that we've been able to recycle much more funds than we did before on the energy side, amongst others. Thereby, we receive money from the government every year, but we're investing 3 times as much as we receive because of recycling of funds. That's been one aspect that's been a highlight for me. I'd say second highlight is that we've been worried that too much funding would go purely to climate and not for development, for job creation. And now we have that in a separate mandate. And we raise separate funding for that and large funding so we can keep on focusing on job creation as well. That's been a second highlight. And thirdly, I'd say I have a great team, Norfund, 33 nationalities. People are very driven, motivated. And here in Kenya, I have a splendid team who are very driven and keen to make things happen.
I actually thought as we close that financial services would have been one of your highlights, given, your sort of portfolio here.
Oh, yeah. Of course. For instance, we are a large shareholder in Equity Bank. We're also in microfinance. We're in smaller banks. That's also one important way of reaching smaller companies by offering, because, say if you're a smallholder farmer, you don't want someone to be part owner of your farm. You want to be able to get working capital. You want to be able to transact with less costs. You want to be able to get that financial support. So for us, through banks, it's very, very important way of reaching the small-scale businesses, the SMEs. So as such, that's also a highlight. But what I mean is that's been an ongoing, constant business. So as such, it hasn't been new, but it's still very, very, very important.
All right. We've been having a conversation with the CEO of Norfund, the Norwegian DFI, focusing on investments in Africa and drilling down into Kenya and the impact, whether it is between job creation, the climate conversation, and how companies are able to sustain their enterprise. We shall keep on highlighting these issues as and when they emerge, so stay tuned.